Hi, Mike here, and just want to give a little quick talk about stock portfolios. Briefly mentioned in the very first class, and it has to do with how we look at average returns and what average returns mean when we talk about stock portfolios. So let's give a real life example here. This is a great website to play with, portfoliovisualizer.com. It's all free. And there are many things you can do, and you can do timing models, you can do asset allocation, and all asset allocation means is how do you want to invest your money. And the easiest thing to look at is you can backtest asset allocation. And if you click on that, you can go with time period you're looking at, and you're going to start with $10,000 and rebalance annually. So that means every year you're going to rebalance into whatever percentages you're interested in for your asset allocation. And so what would happen is you'd have different asset classes here: stocks, bonds, oil, gold, Pop-Tarts, deli meats, whatever you want to invest in, different percentages. They would have to add up to 100%. Then each year, at the end of the year, they would rebalance, sell some things, buy other things, so that they were always in the same percentage. Now, what's nice about this website is you can put whatever assets you want. So you could say, I'm just going to buy select asset class. These are just different asset classes out there. And you can choose what you want to do. These are not stocks, but if you want to look in the big picture and talk about different asset classes. So what's nice about here, though, is there's some built-in portfolios. And so there are a bunch of built-in portfolios. You can see how different portfolios would exist over time. So we look at this, and David Swenson runs the Yale Endowment. Has done a very good job. And this is essentially, historically, what the Yale Endowment portfolio has been. Different percentages, they add up to 100% in different assets here. So these are treasuries, inflation-protected treasuries, long-term treasury bills, where you put your cash, sort of a safe place. Emerging markets, a little volatile, because you don't know what's going to happen with emerging markets. International developed countries, excluding the U.S. market. These are real estate investment trusts, so real estate, and the U.S. stock market. So he puts his money all over the place. And there are many other portfolios out there you can go copy. The Boggleheads, those are the people that invest with Vanguard and follow John Bogle, who was the founder of Vanguard. So a three-fund portfolio is very, very basic. Just has your money in three different funds. Again, adds up to 100%. But you have bonds, sort of safe, and then global U.S. market, global stocks except for the U.S. market, and then U.S. market again. And you can have something else here, so we can go up to. There's Ray Dalio. Let's see, famous Ray Dalio. He runs a hedge fund. He's got a popular book on investing, and he has what's called the all-weather portfolio. It's a little bit weird. He actually adds gold and commodities like oil, and then he has a long-term treasury. Again, this is sort of a safer place. And then a little aggressive, the U.S. stock market adds up to 100%. So this is what a portfolio looks like. And when they talk about a portfolio, they just say, where are you going to invest your money? And what we would do is analyze portfolios. And this shows you the different allocations here. And I forgot to do something. Let's go back for a second and put that in. We want to have a benchmark. Because, of course, the easiest portfolio is not doing anything and putting all your money in the Vanguard 500. That's what's called the S&P 500. It's an unmanaged portfolio. It's 500 stocks. Occasionally some stocks come in, some stocks go out, but it's a 500 stock portfolio that's not managed at all. And so we want to compare to that. So let's add that in and analyze portfolios. So you get some output here, and you can look at this graph. And what's interesting is that over this time period, this is a very, very long time period. This is from 2006 all the way to present. You can see the green, which is the Vanguard 500, beats everything. And then the other ones all end up about the same place. And you can see there's some dips here. That's when the financial crisis hit. There's a big dip, and everything dipped for the most part. What seemed to be winning for a long time? What was the orange? Portfolio 3. That's the Ray Dalio. That's the all-weather portfolio. And it really won. What I mean by winning is it had the most money of everything. But then the Vanguard 500, the S&P 500, took over again. The time period is everything. This is over the longest time period. You can look at sub-time periods, different years, and you'll see different portfolios with different actions over different years. And what's kind of neat is you can see all these are relatively the same, and we're looking for the green. The green is the Vanguard 500, so far doing pretty well in 2019. Everything's doing well in 2019. Lost almost the least amount. One was positive. Everything was negative here. One big. Look at 2013, right? This is a reason not to try to be picking certain assets and just say, hell, I'm going to put everything in the S&P 500 because it's won recently from 2010 on or so. It's been the place to go. Why would you want to try to pick assets intelligently? Look over here, 2008, where if you're in the S&P 500, you lost 37%, or if you're in Portfolio 1, you would have lost 24%. But what we want to talk about right now is a weird thing you see in this output called cagr. So standard deviation is the measure of spread. So this is talking about the yearly returns and how spread out are the yearly returns. The higher this number, you'd say riskier, the more spread out the returns are. The smaller the number, the less spread out the returns are. And so Portfolio 3 has the smallest standard deviation by half almost. Look at that. And so it's considered the safest portfolio. Now, it's also not the worst one because it grew 10,000 to 23,000. Portfolio 2 grew 10,000 to 20,000. Not so good. Higher standard deviation. And these are other measures of risk called the Sharpe ratio, Sortino ratio. They're a ratio of return versus risk. And again, you want for dollar return per dollar risk, you want these numbers to be high. So that's why Portfolio 3, even though it didn't do the best out of everything, low risk, better return. You can see the best year, of course, is the S&P 500, but also has the worst year. So, and then drawdown is what's the worst it got before you recovered. You can see Portfolio 3 looks pretty good. But what is this cagr? Cagr stands for Compound Annual Growth Rate. It's what people look at when they're comparing different investment schemes. And the reason for that is we can't look at the average of the returns. It's erroneous to just look at the straight X bar average of all the returns. If you made 50% one year, minus 50% another year, that's an average of 0. You didn't go back to 0. You actually lost money because of the way percentages work. So cagr is an artificial number, but it says, what would you have to compound your money at yearly to get from 10,000 to 23? So it says, if each year I made 6.84% over this time period, 10,000 would grow, Kevin again, files. 10,000 would grow to 23,000. So it's a great way to look at things. cagr is always less than X bar. It's always less than the average, but it's a more realistic number to look at when you're looking at investment returns. And so we would say, oh, what has the highest cagr? Well, the S&P 500. So that's the best over the long haul. On average, it returns 8% year after year, but that's an artificial number. It doesn't return 8% year after year. Sometimes it's negative, sometimes it's positive, but this is what we think of when we think about average return. For investment schemes, we often don't talk about X bar, the arithmetic mean, but we talk about what's called the compound annual growth rate. It's also called the annualized return. And it's just an artificial device to say, if we invested in Portfolio 1, historically, we would make 6.5%, 6.58% year after year. In reality, we don't make that, but it's a way to think about what our average return is, quote unquote. So cagr is kind of a cool thing to know about. People talk about it a lot. If you take capital markets or more econ classes, or there's some Kennedy School classes on investing, they'll talk about compound annual growth rate. But again, it's also called annualized returns. It's a way to measure how your money would grow at a regular rate. And we use that to compare different investment schemes. So hopefully you know a little bit more about investment. We'll talk more about investing when we talk about random variables. And again, hope you're having a great day when you're listening to this.